Greetings from Singapore to the entire ET family, and especially the organizer of ETBFSI Virtual Summit and those watching. I wish you good health and safety. These are challenging times, and our heart goes out to those suffering from the fallout of this once-in-a-century pandemic. Let's hope and pray for better times to come. In the meantime, let's work together to support our families, communities, and businesses. I have been asked to provide a view of the economy at the beginning, which I will keep short because the ground reality is apparent to everyone on this call. It is going to be a tough quarter, no question about it. Is the difficulties of the April-June quarter spill over into the July-September quarter? Probably. I don't think this is one of those surges that can take care of itself within a matter of weeks or a month or two. So the fallout will continue. Even as infection rates fall, the fatality rates will lag. Even as stringency measures are withdrawn, the population, which is now scarred from 2 waves in the last 1 year, will take their time to go back to business as usual. So it will be tough going both this quarter and perhaps also next quarter. Now, there are certain factors which are not the same as last time. Last time in 2020, we did not have enough information about the pandemic. We still had a lot of disagreements about how to deal with the pandemic. And once the government decided to impose a lockdown, it was system-wide across the country. Contrast this to today. Of course, the dimension of public health is graver, no doubt about that. But we know better. We know the protocols to deal with this disease. We know the protocols to keep ourselves safe. So even as infection rates and death rates look alarming, the fact of the matter is the same wave at this time last year would have been far more devastating. Also, with respect to policy stringency, it is not system-wide. It is now heterogeneous. Some states, some important states, obviously have fairly stringent lockdowns. A state like Maharashtra, for example, there's nothing else to be done. The infection rates are substantial, and the lockdown has to be fairly comprehensive. But then there are other states in India where things are not as draconian, simply because the infection rates are not as alarming. So I think that as the situation evolves, some states would ease up, other states may have to tighten because they are sort of lagging in the entire process. But net, it would not impart the kind of wholesale cost that the economy incurred last year. So just from a financial cost perspective, it will be better. The statistic will show the death toll, the rates of infection being much worse than last year. But I think I can say this with a degree of confidence that the same situation last year would have led to even greater loss of livelihood and lives. It's a counterfactual, we cannot test it, but that is the case simply because we know better, we have the protocols in place. When you look at the market's reaction to this surge, it also tells you that the thinking among market participants is also somewhat similar. They think that the economic cost would be less than last time. The market participants believe that this will be transitory because we have better know-how. Even though it looks very bleak right now, this will pass within months and quarters. It will not take years. And as a result, markets by nature being forward-looking are pricing in normalization down the road and therefore are not willing to sell their assets holdings in a willy-nilly manner, which is why even if there is some outflow happening here and there, particularly with respect to FII outflows in the equity market, domestic investor sentiment, overall flows environment are not outright negative for asset prices. They have held up so far pretty well. No, I should not be very confident and say that this is likely to be the outcome for the rest of the year. If for whatever reason the pandemic were to worsen and the lockdowns were to be extended, of course that economic cost will show up in asset prices. But so far, given the way things are going, I think the market's resiliency tells us something. The markets are not being irrational. They're just looking at the past 15 months evidence and are trying to basically price in a recovery of sorts within quarters, if not a shorter period of time. Now, when I say that, we now know better. So what do we know better now? it's not just a question of, how to deal with a COVID patient, how to give them oxygen correctly, how to apply various antiviral medication, how to keep the wards clean. It's not just that. Those things are there, but then there's an issue of availability of certain equipment and material. There's an issue of the hospital becoming overwhelmed. So those things are, of course, there. When I talk about we know how better, it's also about the economic dimension. We know how to help people in need. We know how to bring assistance to them because we have done it a year ago and it was fairly successful. We know how to keep factories going, how to keep agriculture going, even if there is a big outbreak of the disease, because again, given last 1 year's experience, we know how to carry out these activities safely, even if the data on the pandemic show really alarming numbers. So that's my nutshell view on the economy. I'm not going to go into greater details about the outlook for retail versus production versus exports. Those things are a function of external demand to some extent, which is fairly good, and to some extent domestic demand, which of course is not very good. But if you put it all together, the call for wholesale downgrade of revision, in my view, is premature. Downside risk to the economy has increased, but there are still know-how protocols in existence which will allow us to ride through this storm. I'm sure about that. I'm going to move on to the second part of my talk, which is about the pandemic, but with respect to the banking and financial system. I think 15 months into this pandemic, we can confidently say that across the world, banks have held themselves in good stead in this crisis. One of the big legacies of the 2008-2009 financial crisis was to make the banks safer by forcing them to raise more capital, have higher and stronger buffers, keep less risk on their books, and the banks have abided by that. So even Indian banking system, which has had a torrid time in the last 5-6 years with respect to bad loans, they themselves did not fall into significantly deeper hole just because of the pandemic happening over the last year or so. So on one hand, we have a regulatory input into the banking system over the last decade or so, which has helped the banks deal with this crisis fairly well. Second is policy. Whether it is in India or in Singapore or in the US, the authorities step in with a great degree of forbearance, loan guarantees, cash infusion, interest rate cuts. All of those things have helped banks and financial sector institutions. And as a result, they have been able to continue giving out loans to the worthy borrowers. They have been able to keep somewhat at distress loan on their book, not having the need to call them because of the various forbearance measures that the authorities have put in place. So on one hand, we have better financial buffers. On the other hand, we have better policy response. There's a third pillar, which has allowed the banks to perform well in this crisis. That's technology. I think where the banks are today with respect to technology versus where they were 10, 15 years ago is just astonishing. And again, it doesn't matter whether you're a developing country bank or a developed country bank, the bank's system's ability to reach out to their customers, to continue business as usual, even if people are working from home. And by people, I mean both the clients of the banks as well as the workers in the bank, is amazing. And I think through this crisis, that technology stack of the financial system has held up very, very well. There haven't been any payment failures. There haven't been any curtailment of the services that customers expect from their financial sector counterparties. And as a result, again, the banks have managed to provide a very critical support role to the community, to the society in dealing with this crisis. This now takes me to my meat of my presentation. What can banks and financial institutions do going forward? Now, I work at DBS Bank, which has a presence in India, but it is headquartered in Singapore. And my bank is very tech-oriented. So what I want to share with you is some of the things that we are doing at DBS, which I'm sure is not unique. Many banks around the world, including in India, are doing those things. But I think what I'm going to do now is talk about 4 pillars of to-do. Things to be done now, things to be done going forward that can hold the banks in general in good stead. But also these 4 pillars that I will discuss now will be applicable to the financial sector in general. So first, one of the four pillars for the bank system to do is to pursue what we call augmented banking. So you see, it is no longer about having a bank branch or having a bank website where people can do certain transactions and carry out services. I think customers demand more, and the banks have the capability of delivering more. And if they want to keep their customers, they better deliver more. So what sort of augmented banking am I talking about? I'm talking about things that the banks can do to enhance the experience of customers. They can create robo-advisors for their clients so that they can invest using simple rules and algorithms, which does not require face-to-face human interaction, but it's rules-based, it's transparent, it's cheap. What else can the banks do to enhance the customer experience? They can eliminate hand signatures and come up with biometric signatures, work with regulators to come up with a protocol. They can do digital onboarding, not necessarily requiring physical copies of a volume of documents, but allow the customers to upload the PDF versions and use them to do all the due diligence and do everything digitally seamlessly. They can provide all sorts of research services, whether it is intelligently curated news or research insights, again, through electronic mails, through their website, through their apps. So come up with new ways of interacting with your customers, provide them with valuable experiences, joyful experiences with value added, and then they'll keep coming back to you. That's the way you retain customers. That's the way social media companies are successful. Banks of the world, financial companies of the world have to take a page out of that and give end-to-end seamless experience to their customers. So augmented banking is very important, not your usual core banking, more than that. Second pillar for banks is the area of open banking. By open banking, what we mean is allowing banks within the banking system, as well as within the entire broader financial sector, to come up with pipes so that there are no silos, information, payments instructions can go through seamlessly and cheaply across the entire financial sector. So combine the services you offer as a bank to services other banks offer or other vendors offer. So think about a bank tying up with a food delivery service, a bank tying up with a taxi service, a bank tying up with a digital wallet company. And as a result, clearance, payments, messaging, everything goes seamlessly, makes the customer's life easier, and provides, again, more value to the customer and presumably more revenue to the bank. What are the other areas of open banking? A marketplace for APIs, application programming interface, so that you can do a marketplace for trade credit. You can do a marketplace for reserve management. You can do a marketplace for cross-border payments. And I'll talk about that a little later, even more. So having marketplaces where other participants can come, work with you as a peer with the ultimate goal of providing better services to retail customers, to institutional customers, and services across retail and wholesale, I think is absolutely critical. And that's the way the sector will prove its value to the customer community. Now, no discussion on open banking can be complete without the mention of blockchain. Now, I know that the primary audience of this conversation is residing in India, and the authorities in recent months have shown some degree of skepticism and regulatory resistance toward cryptocurrencies. So let me be very clear, I'm not talking about cryptocurrencies. When I say blockchain, I'm talking about the decentralized ledger, which has many other use cases beyond just transacting cryptocurrencies. So let's focus on the blockchain use case in the context of open banking. So let me give you a couple of examples. Example number one is something called Trustful. If you want to Google it, Trustful is spelled Trusple. This is Chain from China, big non-bank financial company, Chain's international trade and financial services platform. So recently, DBS announced that it is the first Asian bank to successfully close a trade financing transaction on the platform. Transaction was done on behalf of a Singapore SME, which manufactures, fabricates, and distributes, I think, gems, quartz stones in its US and Singapore customers. But the point is that for that SME, their trade order was immediately registered on the blockchain, which enhanced transparency and gave iQuartz, this company that I'm talking about, greater oversight on its supply chain. So once the trade commitment was fulfilled, acknowledged digitally, the bank, in this case is DBS, can facilitate the payment to this supplier, this company supplier, automatically via the platform. Again, if you Google Trustful, TRUSPLE, you will see what I'm talking about, especially if you're interested in the idea of using blockchain in the context of trade finance and so on. SMEs can also apply for bank payment guarantees, purchase invoicing, financing, all of these things through these platforms, which are again blockchain-based, giving a huge layer of transparency and tracking to all the parties involved. So normally when we have cross-border transactions, we have many parties, companies on each side, banks on each side, payment companies in the middle. All of those things, if they can be brought into a transparent tech stack, it helps everybody. So this is one example of a blockchain helping what I talk about in the context of open banking. There are other things you can do. Partior, again, a big mouthful of a word, P-A-R-T-I-O-R. Again, look it up. It's a DBS, JP Morgan, and Temasek joint venture. It's a cross-border payment hub and spoke model, digital clearing and settlement for payments, developing wholesale payment rail based on basically digitized commercial bank money to enable instantaneous settlement of payments for various types of financial transactions. So brand new initiative just came out a few weeks ago, but one more example that using the digital angle, we have many, many ways we can reduce the cost of payments and transactions for our customers. But to do that, one bank cannot do it alone. One regulator cannot do it alone. We have to embrace the open banking model to get everybody involved, and again, with the customer in mind. So I've talked about augmented banking. I've talked about open banking. Let me now talk about what is known as cognitive banking. So that's the third pillar. Cognitive banking, as the name suggests, is about intelligent ways of coming up with customized solutions for your clients. So in DBS, we call it N equals 1, hyper-personalization. It's like the way when you surf TikTok or Facebook or Instagram, the algorithm of that particular app knows all about your usage history and provides you with a set of content that is made just for you. Why can't we do that as banks? We have a lot of data. Why can't we analyze those data smartly and provide our customers with unique, tailored ideas and recommendations? Can't we create a recommendation engine for our clients based on that? Can't we look at their trading pattern? Can't we score their credit history better using all this information? Can we even go beyond our banking data and find other sources of information of our clients without compromising their privacy? And again, use all that information to extract insights about their preferences and needs and provide them with services and a solution. So that's cognitive banking. Not one size fits for all, not something that a product team develops, something we develop after we have attained the insight of what the needs of the clients are. Finally, automation banking. So we talked about, again, open banking, cognitive banking, and now automation banking. So as the name suggests, it is about automating services. You can automate a bank's organizational resources. You can automate fraud analytics. You can do anti-money laundering, AML, CFT type work using automated banking, AI, audit and tracing, loans approval. All of those things should not be subject to many days of processes, many human interaction, lots of ad hoc decision making. They should be part of a seamless process done automatically, very, very cheaply, but using lots of data, using the cutting edge in machine learning and artificial intelligence. So once we can do those things in these areas, we can certainly help our customers. We can certainly improve our services going forward. Again, it doesn't matter if you're a bank sitting in India or in Singapore. These technologies, these services are within the capabilities of all serious banks in the world. So again, augmented banking, open banking, idea behind cognitive banking, and automated banking. Let's keep these four things in mind. Finally, I want to finish my talk by focusing on the key legacies of this crisis, both for banks and societies in general. So I think there will be a lot of scar from this crisis. It'll take us a long time to recover from it. But there will be also very useful lessons for the society. I think the first important lesson for the society is, of course, the importance of our health sector and the entire national security dimension attached to being able to produce our own medicine, having a viable, thriving pharmaceutical industry that can provide all the things the population needs at times like this. Not also only in normal times, but also during times of stress. The system should have redundancies. Systems should have some degree of extra capacity so that it can be ramped up at times when borders can close, markets can cease to operate. So that's a very important lesson. Also, related to that lesson is the need to expand money spent on public health. So more local and publicly funded hospitals and clinics, better services, better capabilities. We have to do that. There's absolutely no choice. The public will not accept anything less after what has happened in the last 15 months and will continue to happen going forward. Second very important lesson for this crisis is the recognition of interdependence. I mentioned just now that you have to prepare for times when markets cease to operate or borders can close. But at the same time, I think a rude recognition from this crisis is that the virus knows no border. Even during the time of the Middle Ages, when there were no planes or cars or trains, virus moved from one jurisdiction to the other jurisdiction, spread from one part of Europe to the other part of Europe within days, if not weeks. So today, even if you close borders, sooner or later, because trade and commerce will have to continue, the virus will jump from border to border. And at the same time, nobody can stay isolated and closed border forever. So our interdependence is a critical takeaway from this crisis. We may have to close borders time to time. We may have to lock things down time to time. But in this crisis, we're in it all together. You may have some countries right now really ahead in the vaccination game. It doesn't matter. If the other big populous centers of the world, China, India, Brazil, Indonesia, if those countries don't get a critical mass of their people vaccinated, those advanced countries will not be able to rest easy because, again, we're all in it together. Till the vaccine rollout is mass across the world, till the pandemic is overcome across the world, there'll be nowhere to hide. Finally, going back to my core part of my presentation, the accelerated disruption that we have seen, especially in the area of digitalization and formalization. You've seen this in India, how quickly people switch to ordering food and doing all sorts of services, staying at home and carrying on without much of a loss in productivity or efficiency. This is going to be a permanent marker of this crisis. We will not go back to the old days. We will be doing things differently in the digital sphere, and that will probably be a good thing for the society. It will be a much bigger equalizer. See, it is not like 10 years ago when there was a huge digital divide between the haves and have-nots. Today, a mobile phone is accessible to most of the population except for the extreme poor. And as a result, the middle class, the lower middle class of the population still have some degree of access to the digital world. They're not fully shut off from it. And I think everybody, again, being part of this call will relate to what I'm saying. And therefore, the ability of governments to send help to people through digital means, the ability of companies to provide services to people through digital means is far wider and far reaching today than it has ever been. So to me, that is the key lesson of this crisis, that even if there is a vicious virus out there infecting people, we can fight the virus through our digital capabilities and deal with it in a far more productive, efficient manner than we've ever done. That's it from me. I thank you all for listening to me, and I wish the conference organizers the best of luck for the remainder of the sessions.